In this video, I want to take on an important topic within financial markets, private equity. This will be an introduction to the topic, and if you'd like to know a bit more, do let us know at the end of the video. Now, private equity is one of those buzzwords that's bandied around, and quite a few people have asked me, what does it actually mean? So clearly there's a little bit of confusion, and hopefully in this video, I'll cover the basics as to what private equity firms actually do. They're certainly big enough. The top 5 firms globally raised something like $150 billion worth of capital over the last 5 years, and names such as Blackstone, KKR, Carlyle Group, TPG are the kind of big players in that space. So what are they all up to, and what are other private equity firms up to? That's the topic I'm going to cover today. Now, private equity is basically a way, as it sounds, of raising equity privately. So private equity investors tend to be looking to buy shares on the whole in certain types of firms, which I'll cover in a moment, and they tend to be private companies, although they don't have to be. So it is private equity capital that's being supplied. Now, there are 3 basic categories of private equity investment route, if you like. Opinion divides a little bit on this, but in my opinion, there's about 3 routes. First of all, you've got what's called venture capital. This all comes under the private equity umbrella. Venture capitalists are firms that basically specialize in investing in small private startups, typically high risk, requiring sort of what's sometimes called seed funding to get going and expand. All right, so these are companies that are off the radar, they're not publicly traded, you and I can't buy shares in them, and they're looking for venture capitalists to come in, and those venture capitalists will supply equity, and they'll look potentially to cash in later when the company goes from being private to public. All right, and in the meantime, they'll look potentially to take a seat or seats on the main board and have quite a say in how the business grows and develops. All right, so essentially the sort of goal there is to move firms from private, that's private ownership, into the public sector, and typically then cash out their stake and move on to the next company that requires investment. Good example, those people who want to sort of name in this space would be the likes of, say, a 3i. Now, the second sort of private equity area is providing what I'd call growth capital for existing, potentially quite large, quite public firms. So sometimes companies will look around at the options for growing and expanding. They're looking for something which is potentially relatively cheap and will achieve their aims, and they'll bring in a private equity firm as the kind of experts, if you like, because private equity firms claim to be good at not only providing growth capital, but also providing sort of expertise, management expertise. They claim to be able to supply experienced professionals who can help the firm grow. So sometimes you'll find that they're involved in bringing capital into an existing firm that may be already quite large. It may be a listed PLC, for example, that's looking for extra money and takes it from one of these big private capital firms. And perhaps the one that makes the headlines the most often is what's often known as the leveraged buyout. Okay, that's a pretty broad category. Anyone who's read the famous book Barbarians at the Gate, all right, when a private equity firm called KKR got involved in the LBO leveraged buyout of RJO Nabisco, will have some idea about what's involved here. But this is private equity firms sometimes coming in with a lot of money and saying, basically, what we can do is gobble up a firm. So here you might be taking a public firm private, almost the opposite of this route over here, taking a public firm private, and what they're looking to do is sort of gobble it up, make improvements, and then often reverse the process later. So they'll spot a sort of target, buy it off its existing shareholders, look to make operational improvements, and then sometimes sell it back to the market at a higher price. So if you like, that's almost going sort of public, private, public, if you want to see it that way. Now, how do they do that? And what's the justification? Over here you get all the headlines generated, sometimes quite critical, how do you do that? I mean, how do you improve the way that a public company is being run by taking it into private hands as a private equity firm? Well, what they claim to be able to do is to bring in better management, operational improvements, make changes that these big, stodgy public companies have failed to make over the years. Okay? In truth, this can be quite controversial because in truth, although some of the better private equity houses almost certainly do bring in improvements, changes in the way that the firm is managed and operated, over here, some private equity firms have been accused of simply cost-cutting, literally slashing costs to the bone, which short-term will boost performance, firing staff, downsizing and so on, selling off non-essential assets. And on top of that, funding what they've just bought with a mountain of cheap debt finance, okay? And that's another little trick. All right, gearing, as it's called, and I cover in another video, allows you potentially to take a firm, stuff it full of debt, okay, make a few operational improvements, cheap, quick ones, I say cheap, but quick and easy ones like cost cutting and so on, and then get rid of it again at a higher price. And during the boom years, okay, before the financial crisis, quite a few private equity firms were accused of doing exactly that, riding the boom in cheap debt, taking out the sort of fast costs and cashing in later, and at the expense of all sorts of stakeholders, including employees, former shareholders, and so on. So there you have it. Essentially, three ways that private equity firms can get involved in companies. Now, who are these private equity firms? I'll just finish on a couple of points. I mean, where do they come from, if you like? Well, typically they're run by so-called experts from various walks of industry, ex-CEOs, okay, ex-investors and so on. And in terms of how the private equity firms themselves are financed, and where do they raise the capital from to be able to go out and sort of gobble up other public companies, for example, comes from one or two sources. Typically it will come from institutional investors such as pension funds or life insurance companies, and or it'll come from whoever ultimately owns the private equity house, because some of them are owned by bigger organizations such as some of the big investment banks, Goldman Sachs, for example. All right? And what about you? I mean, there's all this action going on. There are firms sucking in venture capital, growth capital, okay, going through the LBO process potentially. So how do you, as a private investor, get involved in all this? Well, there's two or three routes in. There are one or two listed private equity firms around, 3i I mentioned earlier on, for example. So sometimes you'll find you can buy a share in a listed private equity company, so a company that specializes in doing this kind of stuff. Another common route in is a fund, all right, which kind of spreads your investment across different types of private equity, if you like, perhaps down at the venture capital end. And there is actually a vehicle called a venture capital trust in this country, it's the UK, that enables private investors to get into the venture capital space. I might do more on that in another video if I get requests for it. And there are one or two other routes. There is, for example, an exchange traded fund out there. LSE IPRV is the code, and that one attempts to track the listed private equity firms in the S&P 500, that's the US index. Okay? So it's not a desperately easy sector for a private retail investor to play. Private equity firms are not looking to you and I to provide them with the sort of the capital they need. $150 billion I mentioned earlier didn't come from the likes of you and I, it came from elsewhere. But there are one or two ways in for a retail investor if you want to get some sort of exposure to private equity. Okay? As for the are they good or bad, all depends on who you're talking about. Okay, some of the top firms undoubtedly bring in expertise that small startups and existing large firms simply don't have. So they do offer genuine improvement. But the accusation in the run-up to the financial crisis was that they were joined by lots and lots of slightly more Mickey Mouse outfits who just looked to make a quick buck by loading up their target firms with cheap debt finance. So there you have it. If you'd like to know more about this topic, that was a very basic introduction, do let us know.